Debut of our inaugural economic and staffing forecast. For the better portion of a year, the ASA research department was working on a forecast that would allow us to basically get an idea of economic trends and how they would affect the staffing industry. And so essentially what you're going to hear today is going to be an overview of where we see the economy going and what that's going to entail for staffing employment. Now, I'd like to make a brief note to those who are not economists and do not have an economics degree. This is not an economics seminar. This is not even a lecture that you might see at a staffing conference about the economy. This is a simple, no frills, high level snapshot of our projections of what we see in the economy and how that might affect the staffing industry. And so, with that, I'm going to jump right in and hopefully remove some of this clutter for you guys. So, about a month ago, we at ASA held our annual executive in which we had a speaker named Jim Collins, and he made a presentation that was based on this concept called brutal truths, which were unpleasant realities that folks had to acknowledge before they could deal with. And so, in a very similar fashion, our economic forecast has highlighted some brutal truths for the staffing industry in terms of the broader economic landscape which it faces. So, I'm going to start by looking at staffing employment and then working backwards. What our model shows is that staffing employment is going to decline within the first quarter of this year by about 6.1%. Now, it's not going to be as dramatic of a downturn as we saw in the last quarter of 2024 at about 7.1%, but it is still going to be a decline. And the reason for that is going to be due to a couple of major economic trends. The first is GDP. Our model shows that GDP is going to be growing at about 1.2%. A healthy growth for GDP is about 2%, and growth last year for GDP was about 2.5%. Quite similarly, looking at inflation, we're projecting that the two major metrics of inflation, CPI and PCE, are going to be growing at about 3.1% and 2.6% respectively. Ideally, you would want to see inflation grow at around 2%. So therefore, our model shows that inflation, at least in the first quarter of 2025, is going to be running much hotter than what we'd like to see. And finally, because we're seeing an environment where there is lower levels of economic activity, which is going to be weighing down on appetites to hire, as well as higher inflation, which is also going to be weighing down on appetites to hire, we are expecting an increase in the unemployment rate to about 4.2%. So let's jump in one by one. To start, we're predicting a 1.2% increase in GDP in the first quarter of 2025. GDP, very broadly, it can be measured by growth within four categories: consumption, business investment, government spending, and net exports. Consumption comprises about 60% of GDP. Therefore, what our model is showing is that we're going to primarily see reductions in business investment, which is projected to grow by 1.4% in the first quarter of 2025 versus 2.5% as an average in 2024, as well as an enlarged trade deficit, which is going to increase from about 1.07 trillion to about 1.08 trillion, due predominantly to a lot of this uncertainty that we're seeing with respect to tariffs. Now, fortunately, business investment and net exports do not comprise 60% of GDP. Otherwise, we'd be having a very different conversation. So because these two components of GDP are going to be facing some headwinds, we don't expect to see that strong GDP growth that we saw in 2024. However, we're also going to see reductions in consumption, which is going to stabilize economic activity, but it's not going to allow for robust growth. Now, consumption is going to face some retrenchment due to not only softening within the labor market, but also the hot inflation that I was mentioning. And so, because consumers are pulling back from making large purchases and spending their money within the economy, that reduced economic activity is going to weigh down on businesses' appetites to hire more workers. And so, therefore, we're going to see a decline within non-farm payrolls as well as general opportunities within the labor market. Now, you may hear some economists talk about a concept called stagflation, and that is a phenomenon in which economic growth is very low, but at the same time, prices are very, very high. Now, while the way that we are going, we could certainly come to that scenario, it is a long way off in the first quarter of 2025, primarily because we still haven't experienced 2 quarters of negative economic growth. We haven't even seen 1 quarter of economic growth. But because we're going to see normalization in consumption rather than a full-on decline in consumption, those worries about stagflation right now are overblown in our opinion. And before I jump to inflation, there are going to be a couple of verticals within the staffing industry that are not going to follow this typical trend of normalization. The first is going to be healthcare staffing. Healthcare staffing remains one of the biggest contributors to staffing employment, and that is due to unique supply and demand dynamics within the healthcare sector. Healthcare is still very, very hot because there's a large amount of turnover, particularly amongst healthcare support occupations. And so, because of that, we believe that the healthcare vertical is still going to remain hot within the staffing employment space, even though we're going to see reduced levels of economic growth. Quite similarly, in this environment of lower growth, we're going to see a lot of companies move from investing in more headcount to investing in more productivity, trying to utilize the resources they already have to attain that bottom line. And so, because of that, we're also expecting to see the engineering, IT, and scientific services vertical of temporary employment increase as well, primarily due to increased demand for occupations within the computer programming and mathematics space, folks who know how to leverage technology in order to help companies achieve their bottom line in a time of slower economic growth. And now to what I was talking about just a little earlier, inflation. Now, as I mentioned earlier, inflation generally should be growing at about 2%. And our models suggest that both major metrics for inflation, which is consumer price index as well as personal consumption expenditures, they're going to be running pretty high. They're going to be running at 3.1% and 2.6% respectively. Now, the reason for inflation running so hot is going to be due to a combination of traditional as well as non-traditional factors. Traditional factors that have been keeping inflation so high are due to elevated costs within housing when it comes to both mortgages and rent, as well as other core services, particularly within the medical field in terms of the cost to go see a doctor, as well as the cost for prescription drugs. However, there are a couple of non-traditional elements within the economy that are also going to be bolstering inflation as well. Primarily, that will be due to an increase in the price of food as well as energy. If anybody here likes a good omelet like I do, you'll know that there's been a bird flu recently that's been affecting the price of eggs as well as a lot of other foods that are sourced from eggs. Additionally, we also know that the prices of gas are rising, and because gas is still used to transport just about every major commodity in this country, we know that there's going to be an increase in supply costs. And that is what our model sees as keeping inflation elevated. Due to the fact that inflation is going to remain elevated in the first quarter, as well as for the considerable future above that 2% target, we are anticipating that the Federal Reserve is going to limit the amount of rate cuts that it provides to just two throughout 2025. And this is only going to be subject to change unless we see a significant drop within inflation or we see significant softening within the labor market, which means that the Federal Reserve is going to have to pivot its focus towards restoring labor market stability over trying to bring inflation down. Now, this phenomenon of inflation is going to weigh quite heavily on the professional managerial segment of staffing services. Our model shows that the wages of employees within the professional managerial vertical declining by about 7%, and that is on target with estimates that we have seen from other sources, which also show that executive salaries quite broadly have been declining within this high inflationary environment. Quite similarly, what we're also seeing is that employment within the professional managerial vertical is also going to decline. Well, it's going to decline in terms of growth. So what I mean by that is that in 2021 or 2022, at the start of the Great Resignation, we saw employment within the professional managerial vertical as at about 5%. Our model right now is predicting that professional managerial employment is only going to grow at about 0.5%. So quite a significant drop, and a lot of it due to the high inflationary environment which we find ourselves in today. Next, we're going to look at the labor market. So I just mentioned two very important headwinds. First, lower levels of economic activity as well as high levels of inflation. So in other words, what employers are dealing with is an environment in which there's not that much demand for goods and or services, and they're also dealing with high costs to bring on new headcount. And so therefore, what we see is that the growth in non-farm payrolls, or the number of jobs that are being added to our economy, is only going to grow by about 0.5% within the first quarter of 2025. And quite similarly, as we see this decline within the number of new opportunities within the labor force, there's also going to be increased focus on possibly reducing headcount where possible. And that is why our model also shows that we're going to be seeing the unemployment rate increase to about 4.2%. Just last week, we saw that the unemployment rate increased to about 4.1%. And where I think our model is a little bit bullish in terms of the actual rate where unemployment will sit is because there are quite a few headwinds that are coming down the pipeline that could yield increased unemployment. The first being the cuts to the federal government. As we all know from the headlines, this administration is very much focused on reducing the size of the federal workforce. And while some estimates suggest that the unemployment rate could simply skyrocket due to all of the cuts within the federal government, we take a bit more of a moderated approach. The federal government right now comprises about 1.87% of the total workforce. And so right now what we're seeing is about upwards of 200,000 employees have either been terminated or they have accepted buyouts from the federal government to leave their posts at a different time. So therefore, what we think that we're going to see within the first quarter of 2025, particularly within March's employment data that's going to be released next month, is going to be a modest uptick in the number of layoffs and separations altogether from the federal government, but nothing that is going to be no real jump within that unemployment figure. Quite similarly, what we also believe is going to happen in the long term is going to be more cuts that are pertaining to the administration shift within trade policies. So ASA has done some research, and what we have found is that the tariffs that have either been announced or have been suspended affect about 80 different goods across 14 different NAICS industries. Now, the overall percentage of the temporary help employment workforce within the manufacturing space is about 13%. However, these tariffs are expected to afflict about 84% they are the manufacturing and light industrial space altogether accounts for about 84% of the total workforce impact of tariffs. And so, therefore, we do believe that some additional softening within the economy due to the tariffs that are going on will have a negative impact on the manufacturing sector and particularly within the light industrial space. Now, I will mention that according to the jobs report that we got last Friday, we did see the second consecutive increase in light industrials employment. However, what we do expect is that because of these headwinds with respect to trade policy as well as inflation, that those employment gains could see some reduction over the coming months based on these costs as well as the reduced appetites amongst employers. And finally, this brings us to staffing employment. So, what we see is that staffing employment is going to decline by 6.1%. What our model shows is that right now, employment costs are running at about 3.9%, where pre-pandemic growth they were running at about 2.8%. Conversely, what our model also shows is that labor leverage or the ratio of the employees quitting their jobs to the employees getting laid off from their jobs is at about 1.1% compared to 2.3% in the pre-pandemic times. So in other words, employment costs remain much too high and labor leverage remains much too low. And so because of these trends, we believe that we're going to continue to see a decline within overall staffing employment. However, we believe that these declines are going to be reversed in the long term as not only the economy stabilizes, but as we're also able to achieve progress on reducing inflation, and if we're able to do so in a way that allows for the economy to continue growing. One important point that I'll note is that when it comes to the distribution of employment gains and losses within the overall staffing number that we see, the trend that we're seeing is that those verticals that typically have lower levels of demand for staffing are going to be accounting for the majority of gains within staffing employment, whereas those verticals that usually have high demand for staffing employment, they're going to see more losses. As I had mentioned earlier, the healthcare vertical and engineering, IT, and scientific services vertical, we anticipate that there's going to be continued demand within these verticals due to very unique sector-specific conditions, such as, the supply and demand imbalances within healthcare, as well as an increased demand for computer science, as well as technically minded individuals. However, healthcare and professional staffing services, they only comprise about 20% of total staffing employment, whereas a vertical like light industrials, which accounts for about 50% of total staffing employment, we see that that particular vertical is going to be facing some significant challenges due not only to the economic environment that we find ourselves in, but also due to policy changes that may be coming down the pipeline. And that is our very first set of projections from the economic and staffing forecast. Now, I intend for these webinars to really be an opportunity for not only the research team to be able to share with you what we're seeing down the road, but also for you to be able to ask us questions about our projections as well as what our analyses entail. So therefore, I would like to open it up to any questions from folks who are on the call. Thank you.
Thank you, Noah. We do have a couple of questions. One of them is asking for clarity relating to tariffs in the manufacturing light industrial space. You mentioned that 84% of the total workforce impact will be from tariffs there. Do you mind saying a couple more words on that?
Yeah, absolutely. So essentially, what in our analysis, what we found is that the impact of tariffs on the goods and services that are going to be consumed across all different sectors of the economy, 84% of that effect is going to be concentrated within the manufacturing space. Now, when it comes to staffing employment within the manufacturing or more broadly, light industrials vertical is about 50%. Therefore, what we see is that the majority of the impact of tariffs is going to be within the manufacturing sector and consequently affect the light industrials vertical of the staffing industry.
Thank you. I have another question. Do you foresee a likely potential catalyst that could jumpstart job growth in the coming year?
Yeah, absolutely. That's a good question. So we see a couple of tailwinds for economic growth in the future. The first is going to be tax reform. What we saw in during the Tax Cuts and Jobs Act within the first 2 years of its implementation, that would be 2018 and 2019 for reference. So this was before economic conditions went out of whack due to the pandemic as well as its related economic effects. What we saw during the initial phase of the Tax Cuts and Jobs Act was that for every job created within the economy at large, there was about one job created within the temporary help services industry. And so, therefore, what we expect is that making some of those requirements permanent within the Tax Cuts and Jobs Act, that is going to be a booster for employers to want to hire more temporary help services workers. Another one that we are also seeing is going to be increased deregulation. So what we see is that with the administration's focus on reviewing some of the regulations within the labor space, as well as more broadly, repealing more economically significant rules that were implemented by the former administration. We also see that that could be a potential tailwind to bolster employers' appetites to hire because they have more capital and therefore have benefits to temporary help services workers.
Thank you. Thank you, Noah. We have another question. If inflation will be persistent throughout the year, how is it possible that employment costs might be able to come down?
Yeah, so really what we see is that inflation is going to be the primary driver of employment costs because that's the growing rate of goods and services in the economy. However, there could be a scenario where despite the fact that inflation remains elevated, there could be increased instability within the labor market. And because of that, what we do expect is that when the Federal Reserve does cut interest rates, we expect that that is going to also alleviate some pressure on those borrowing costs that businesses are facing. And so even though inflation might be running hot, because the fact that borrowing costs are reduced, that is going to lift some weight off of employers and prompt them to hire.
All right. We have one more question here. Are there any economic sectors that face heightened recession risk or uncertainty?
Yeah, that's a really good question. So when it comes to a recession, applies to the economy at large. So therefore, we're not going to be if we are in a recession, that's going to be just about every sector within the economy. So therefore, in terms of sectors that are going to be experiencing increased uncertainty, we see that government is going to face increased uncertainty primarily due to the workforce reductions. Right now, government, alongside professional business services, as well as healthcare, that it is one of three sectors that is comprised over 75% of all non-farm payroll growth over the last 12 months. And so, therefore, we believe that instability within the government sector could translate more broadly to instability within the labor market. Quite similarly, we also see that with the uncertainties with respect to tariffs and trade, that manufacturing, but also construction as well, due to its dependence on raw materials, as well as oil and gas, could also be affected as well. I want to also make a point that one area where we do see some potential tailwinds is going to be immigration, particularly for the staffing industry. ASA recently did an analysis, and we found that while staffing penetration rates for individual sectors range from about 0.5% to about 4%. What we see is that with the number of job openings that are already existing within these sectors, compounded by the number of workers who could be affected by the shifting immigration policies, we do expect that those labor shortages could allow for more tailwinds with respect to hiring, and that could also translate to increased demand for temporary workers too.
All right, thank you. That was our last question. So I encourage everyone to please put your questions either in chat or in the Q&A panel. Noah would love to answer them. So we'll keep this open maybe for one more minute. We have about 4 minutes left in scheduling this meeting. Here we go. What are your long-term projections for employment growth in the light industrial sector post 2025, and what indicators should staffing companies monitor?
That's a really good question. So I would say that when it comes to light industrials or just about any staffing vertical, the two major indicators that we on the research team are looking at is the employment cost index, or how much does it cost for companies to add headcount, as well as labor leverage, which is the ratio of quits within a particular sector to layoffs. When there are more quits and less layoffs, that means that employees have more leverage, and therefore when they leave, employers are going to be more likely to fill those roles immediately. When there are more layoffs, that prospect is less certain. And so therefore, when it comes to the light industrial space, what we believe is that the tailwinds with respect to taxes as well as deregulation, that is going to ease some of the pressure off of the impact that we get from tariffs, as well as where inflation is right now within the first quarter of 2025. What we also believe with respect to tariffs is that, like what many folks in the administration are saying, that these tariffs are meant to be short term and they could be changed at a moment's notice. And so, because of that, what we do believe is that these tariffs are not going to have an effect beyond 2025 if they are indeed used correctly as per their purpose of a short-term bargaining chip that allows the administration to negotiate better trade deals and therefore restores us to a more normal trade balance.
Perfect, thank you. We have another question here. Do you have any research regarding which positions are in demand in the engineering and IT sector?
Yes, absolutely. So, like I had mentioned earlier, computational as well as mathematical occupations, they are experiencing the highest levels of growth. However, we're also seeing significant amounts of growth within the social sciences space. So, for economists, financial analysts, we are also seeing a significant growth within those particular occupations. However, what we believe is that the hiring of those occupations is concentrated within a very few segments of the economy, primarily within professional business services. Therefore, I don't believe that you would likely see that same level of growth of, say, social sciences occupations, computational mathematics occupations within, say, the light industrial space, within, say, accommodations, places like that.
All right, perfect. That brings us close to time. Thank you, Noah, and thank all of you for joining us today. As a reminder, these recordings will be available online, but be sure to join us in April for the next installment in this monthly forecast series. Thanks again, and take care.
Thanks, everyone.